Imagine this dot. It's the year 2030. AI is running almost everything: finance, healthcare, transportation, even how companies hire and operate. Some people saw this coming and invested early, and their net worth exploded. Others ignored it, or kept waiting for the perfect time, and they completely missed the opportunity. In this video, I'm going to show you step by step how to build a simple, beginner-friendly AI portfolio, designed specifically for 2030, even if you're starting with a small amount. Stay till the end, because I'll give you a super simple portfolio template that you can literally copy and customize in just few minutes. Hey everyone, welcome back to Future Finance Lab. Here we make the future of finance and AI investing simple and beginner-friendly. This video is for educational purposes only. Alright, let's build your AI portfolio for 2030. Why AI and WA 2030? So first, let's answer an important question. Why are we even talking about an AI portfolio for 2030? Number one, AI is already huge. Many of the biggest companies in the stock market today are deeply connected to AI. Cloud computing, chips, software, data platforms, all powered by AI. A large portion of the S&P 500's value is already driven by AI-related businesses. Number two, this is a long-term trend. Multiple studies estimate that AI could add trillions of dollars to the global economy. By around 2030. This isn't a one-year boom, this is a decade-long wave. And number three, we're still early in real-world adoption. Just like the internet in the late 1990s, most people are still underestimating how deeply AI will be built into everyday life. Even if you don't work in tech, AI will still affect your money. So instead of trying to trade AI hype every month, the smarter approach is to build a structured AI portfolio and let time do the heavy lifting. The three-layer AI portfolio FRMWONK now. Let's talk about the core idea of this video. My three-layer AI portfolio framework for beginners. Think of your AI portfolio like a pizza divided into three slices. Layer 1. Safe AI to 50%. This is your foundation. It should feel boring, stable, and diversified. This layer can include broad market index funds that already hold major AI companies, large, established tech and cloud companies that power AI infrastructure, or AI and tech-focused ETFs that hold dozens of companies. The goal here is simple: capture AI growth without betting on one single company. Layer 2. High growth to 30%. This slice is where you take more risk for more potential reward. This can include first software companies. Data and analytics businesses using AI heavily. Robotics and automation companies. These stocks may be more volatile, but they are directly building on AI technology. Layer 3. High risk minus 20%. This is your moonshot. Layer. Here, you accept that some picks might fail completely. This can include smaller emerging AI companies. Very innovative but unproven business models. Two important rules for this layer. First, keep it at 20% or less of your AI portfolio. Second, never put a large amount into a single high-risk stock. This 50-30-20 structure lets you participate in AI growth while still sleeping peacefully at night. Example AI portfolio for 2030. Let's walk through a simple hypothetical example. Let's say your total investment portfolio is 100%. You decide that 40% of your total portfolio will be in AI-related investments. The remaining 60% stays in other areas, like bonds, cash, real estate, or non-tech stocks. That 40% becomes your AI bucket. Now we apply our three-layer framework inside that AI bucket. Safe. AI minus 50% of the AI bucket. That equals 20% of your total portfolio. This could be a broad index fund with major AI companies. One or two AI or tech-focused ETFs. High growth. 30% of the AI bucket. That equals 12% of your total portfolio. This might include a few AI software or data companies, maybe a robotics or automation company. High risk to 20% of the AI bucket. That equals 8% of your total portfolio. This could be 2 to 4 smaller speculative AI stocks, each one only 1 to 3% of your total portfolio. Again, this is just an example, not a recommendation. You can adjust your total AI allocation based on your comfort level. The key idea is this: don't Randomly buy AI stocks. Put them inside a clear framework. Risk management and common MISTs. Now, let's talk about how people usually mess this up. Mistake number 1. Going all in on AI. Putting 80 or 90% of your money into AI stocks because of fear of missing out. The solution? Keep AI as part of your portfolio, not the entire thing. Mistake number 2, chasing hype names. Buying whatever AI stock is trending on social media this week. The solution? Every stock or ETF should fit clearly into one of your 3 layers. Safe AI, high growth, or high risk. Mistake number 3, not rebalancing. If one AI stock doubles, it can silently become too large in your portfolio. The solution? Once or twice a year, review your portfolio and rebalance back to your target. Percentages. Mistake number 4, short-term thinking. AI stocks can be very volatile in the short term. The solution? Remember, your timeline is 2030. If you believe in the long-term AI trend, short-term dips are part of the journey. Step by step action plan and let us turn everything into a simple checklist. First, decide what percentage of your total portfolio you want in AI. 0.20%, 30%, or 40%. Second, break that AI bucket into 50% safe AI, 30% high growth, 20% high risk. Third, make a short list. 2 to 3 options for safe AI. 2 to 3 options for high growth, and a few carefully chosen high risk candidates. Fourth, start small. Even monthly investments work. The structure matters more than the amount. And finally, review your AI portfolio once or twice a year and rebalance if needed. If you found this video helpful and you want more beginner-friendly AI investing content, hit like, subscribe, and turn on the bell so you don't miss future videos. In my next video, I'll break down how to research an AI stock step by step, so you can confidently decide which companies deserve a place in your 2030 portfolio. Now comment below and tell me, what percentage of your portfolio would you feel comfortable putting into AI? 10%, 20%, or 40%? Thanks for watching Future Finance Lab. I'll see you in the next one.